If you put $10,000 under your mattress 20 years ago, today you have enough purchasing power to buy a used Honda Civic. You didn't lose a single dollar bill, yet you lost half your wealth. That's the silent crash. And the life raft everyone screams at you to buy, gold, is leaking. Gold pays no dividends, has zero cash flow, and during high interest rate environments, its price often collapses just when you need it most. So, if cash is melting ice, and gold is a heavy rock that pays no rent, how do you actually engineer a portfolio that gets stronger when prices rise? You need assets that legally force the economy to pay you back for the inflation it creates. Welcome to Retire Rich, and today I'm going to reveal how to protect your retirement savings from inflation. Don't forget to like and subscribe for more videos like this. The first layer of this defense is what I call the government's apology. It's a specific asset class called TIPS, Treasury Inflation-Protected Securities. Most people buy standard bonds, which is financial suicide during inflation. If a bond pays you 3%, but inflation is 5%, you are locking in a guaranteed loss. TIPS are different. When inflation goes up, the principal value of the bond adjusts upward automatically. If inflation spikes 10% tomorrow, the value of your TIPS investment rises 10% mathematically. It is the only asset on earth with a government guarantee to preserve your purchasing power. But TIPS only preserve wealth. They don't multiply it. To actually grow your retirement while milk hits $10 a gallon, you need to own the thing that makes the milk. This brings us to the scarcity engine, productive farmland. You might be thinking, I'm not a farmer, but you don't have to be. Through specific real estate investment trusts, also known as REITs, that specialize in agriculture, you become the landlord. Here's why this works when residential real estate fails. When inflation hits, housing prices often soften because mortgage rates go up, but people have to eat. When the cost of food rises, the farmer makes more revenue. When the farmer makes more revenue, the rent they pay for the land increases. Historically, farmland has a near-perfect correlation with CPI, the Consumer Price Index. You aren't speculating on a crypto coin. You're owning the biological constraints of the planet. You can print money, but you cannot print soil. However, there's a trap here. Many REITs use massive debt. In a high-inflation world, debt gets expensive, so you must filter for low-leverage infrastructure. Now, even with land and bonds, you're missing the most aggressive component, the growth rocket. Most stocks get crushed by inflation because their costs go up. Wages, materials, shipping, their margins vanish. But there's a tiny subset of companies that possess uncapped pricing power. These are companies that can raise their prices on Friday, and you will still swipe your card on Saturday. Think of high-end luxury monopolies or essential software ecosystems. If a company raises prices by 10% and loses 10% of its customers, it has zero pricing power. If it raises prices by 10% and loses nobody, that's an inflation fortress. You're looking for gross margin stability. If a stock's margins haven't dipped during the last 3 inflation spikes, that's not a stock. That's a royalty stream on the economy. So, the equation is solved not by hoarding bars of metal, but by triangulation. TIPS for the baseline defense, farmland for the commodity capture, and pricing power equities for the growth. But knowing what to buy is useless if you buy them in the wrong tax account. This can trigger a tax drag, which hurts worse than inflation. I break down exactly which asset goes into which account in my next video, so be sure to like and subscribe, and I'll see you there.